Most founders spend weeks choosing between Singapore and Hong Kong based on tax rates. Then they discover they can't open a bank account, and suddenly that tax advantage means nothing. Here's the truth nobody tells you. Singapore and Hong Kong look identical on paper. In practice, completely different beasts. Singapore feels like a system, structured, predictable, logical. Hong Kong feels like a filter. It lets some through and quietly blocks others without explanation. If you pick the wrong one for your business, you don't just lose time. You lose months chasing a bank account that was never going to approve you. Let me show you exactly how to make the right call, starting with the one factor most founders completely ignore. Every blog starts with tax. That's backwards. Because here's what a bank decides. Whether your company can receive payments, whether your operations can run smoothly, and whether your account stays open 6 months from now. A low-tax structure with no bank account is useless. And yet, this is where most founders go wrong. They pick a jurisdiction first, then try to fit banking into it. Banks do the opposite. They evaluate risk first, structure second. If your business doesn't fit their framework, the country doesn't matter. Singapore's financial sector contributes around 13 to 14% of its GDP. That number tells you something. This is a country that takes banking seriously, with deep structured systems. Hong Kong, meanwhile, remains one of the world's leading financial hubs, built on global capital flows and deep China integration. Both are powerful. They just work very differently. Let's talk about what actually happens when you submit an application. Singapore banks follow a structured approach. They look for three things: clear documentation, defined business activity, and a logical transaction flow. If everything aligns, approvals are predictable. You know what to expect. Hong Kong banks operate differently. They focus heavily on risk exposure. They require stronger justification. And here's the part that frustrates founders. They often reject without detailed feedback. You submit, you wait, you get a no, and you don't know why. This is the core difference. Singapore feels like a system you can navigate. Hong Kong feels like a gate you have to pass. Now, this doesn't mean Hong Kong is impossible. It just means the margin for error is much smaller. If you're not physically based in the country, and most international founders aren't, the gap becomes even wider. Singapore offers clearer onboarding paths for non-residents. The KYC process is structured. In-person meetings are sometimes required, but not always. And timelines are reasonable, typically 2 to 4 weeks with proper documentation. Hong Kong is a different story. The KYC is aggressive. In-person meetings are usually required. And timelines? 1 to 6 months in many cases. Those delays aren't random. They happen when the business model is unclear, the transaction flow is complex, or your documents don't tell a clear story. Banks aren't slow. They're cautious. And here's the hidden advantage Singapore has. It requires one local resident director. This increases trust from banks. It signals local accountability. Hong Kong doesn't require a local director, which makes company setup easier, but it makes banking harder. More scrutiny, more questions, more time. This is why so many founders get confused. Hong Kong looks simpler at the start, but becomes harder at the banking stage. Banking isn't just about getting approved. It's about maintaining the relationship. Singapore is more predictable here. Initial deposits are lower and more flexible. Monthly fees are transparent. Relationship expectations are moderate. Hong Kong banks often expect more. Larger balances, stronger commercial justification, and clearer long-term intent. And here's something most founders don't know. Many Hong Kong banks now require detailed transaction flow explanations before onboarding international businesses. We're talking supplier mapping, expected transaction volumes, counterparty details. Singapore banks perform similar checks, but the process is more standardized. It's easier to prepare for because you know what's coming. Let me be direct about something. Most founders assume rejection is about documents. It's not. Banks are evaluating your clarity, your structure, and your risk profile. Even simple businesses get rejected if unclear. Even complex businesses get approved if structured properly. The business type matters too. Crypto businesses, trading companies, and cross-border service providers face the most scrutiny. Hong Kong tends to be stricter in these cases. Singapore is structured but still selective. The key is how well you explain your business. The bank needs to see a coherent story, where the money comes from, where it goes, and why every transaction makes sense. So which should you choose? Here's a simple framework. Choose Singapore. If you want predictable approvals, you're operating remotely, your business is digital, SaaS, or consulting, and you prioritize long-term banking stability. It's built for scalability. Choose Hong Kong if you need direct China access, you run a trading or sourcing business, you can support higher compliance standards, and you understand banking expectations in advance. It's built for access, not simplicity. There's no universally better option. The question is which one will actually approve your specific business. Banks don't approve jurisdictions. They approve businesses they can clearly assess, verify, and trust. That's where most founders go wrong. They compare locations but ignore how their structure will be evaluated. At Lion Business Co., we focus on that first, helping you build a setup that banks are comfortable approving, not just one that looks good on paper. If your banking strategy feels unclear, a structured pre-assessment can save months of frustration and dramatically improve your chances of approval. Check the link in the description to get started and subscribe for more practical breakdowns on international banking and business setup.